Hello, everybody. This is Brad Reed. I am a real life trader, and I'm here reminding you to be good. And by good, I mean get out of debt, achieve your financial dreams, and give generously to your community. I have the pleasure of being joined by my dad, Ed Reed, in Austin, Texas. How's it going, Dad?
Yes, good morning, everyone. It's a great day to be a real life trader.
And I'm also joined by Art Pierce out in Salinas, California. Is it Salinas or Salinas, Art?
It is Salinas, and good morning,
Salinas.
everybody.
So I got an email last night, and the question was, Brad, what do you use to back trade? And I thought about it. It's like, man, we don't have a video on how to back trade. So Chris Wenzel, thank you for sending me that email. I am going to respond. So before I do respond, back trading is very, very important. Back trading is when you look back in the charts and figure out if your strategy that you want to use would work or not. Um, One article that I've recently written, I know I talk about this a lot, but I wrote it because it would answer about 100 emails that I've received over the last 3 or 4 months. If you click on this where it says articles, there is an article here that says 7 steps to building your own trading strategy. And in that, number 1 is watch the free videos. Number 2 is create your trading plan as it says in the videos. And then I want to talk about 3 and 4. Step 3 is where you write down what entry are you looking for, where will you put your stop, how will you calculate your position size, where will you put your target, and what's the criteria for adjusting your stop order. And then number 4 is look at the charts, scroll back in history, and look for your criteria, then execute what you wrote in 3, B, D, and E. So basically, you go back in the charts and you look for your criteria. Now, and to answer your question, Chris, I use TradingView. Now, here is a strategy that I am back trading. Man, it's a little bit smaller than I'd hoped in this video. But the entry is when a stock gaps out of a consolidation pattern, buy on the entry, so buy at the open. And then the question is, as I was looking through this, is what the heck is, how can I more clearly define a consolidation pattern? A lot of us would know what it is when we describe it, but then when you start going through the charts, you find that there are various shades of gray or various shades of a consolidation pattern. So I have written here one peak and one trough, but basically what that equates to, 2 ups and 1 down, or 1 up and 2 downs before it is considered a consolidation pattern. The stop is the closer of either 1% of the stock price or halfway into the gap. And then I have to decide, is the gap from the previous close, or is it from the higher low of the consolidation pattern? And then target is exit half at 2R and get trailed out on the rest. And then adjusting the stop below or higher the previous day, plus or minus 1 penny, or the 10 EMA. So when you come down here, so I wrote a bunch of formulas to help me execute that. So when I type in the entry here, it'll tell me what 1% of the entry is. Then I can type the consolidation pattern high or low, and then it'll calculate where I should put my stop. It'll also calculate 2R for me. It'll calculate my position size for me. And then I have 2 ways to exit. One exit is the previous day higher lows, and one exit is the 10 EMA. And then over here to the right, it does all the calculations. And then up here, I have it calculate for me what would the average R be if it's the previous day higher low? What would the average R be if it gets out on the 10 EMA? And then what if I do a combination of the two? I've done 17 of these so far, and the average return if I get out at the 10 EMA is 2.5 Rs, which, I mean, obviously I need to do more, but that's pretty cool. Currently, these results are not yet published, but once I get to 50, I will publish these, and maybe certainly if I get to 100, I will have them published. But let's go back and let's back test one. So I just pulled up, let's see, this is CMG. We were looking at this. Actually, I guess we could do this one. Why don't we just do this one because we're here? Okay, so yesterday it gapped up, but did it gap out of a consolidation pattern? Well, I want a high and a low and a high. or the opposite of that. And I don't feel like I really get that. Maybe that's a high, that's a low, that's a high. But really the high of this consolidation pattern is here. I might have done this if I had seen this before. But at any rate, let's just keep going. Here, this one opens, but see the high of this consolidation pattern is here, so it did not clear the open. Now this one gapped up nicely, but there's a high, there's a low. I guess that's another high. So let's go ahead and let's start this one. So the open of this one, actually there's one too. We'll do this one since we're already here. So this gapped up on January 8th of 2015. So I would go over here and I would say January 8th, 2015, and we're looking at CMG. And then I want to know what the open price is, and the open price is 702.50, and it is a retest gap. So call that retest gap, 702.50. And then where is the consolidation high or low? I'll call it the high of this candle, which is 696.56. 696.56. And this says that I'm going to end up buying 17 shares. My 2-hour target is 708.44, and my stop would be 699.53. So now I have to decide, does it hit 708.44 first or 699.53? Well, let's go take a look. Sometimes it can be confusing if it would hit both on the same day. So sometimes you have a candle that it may open here, but it has a long lower wick, kind of like this one. It has a long upper and lower wick. So, but again, the question is 699.53 or 704 something, 708.44. So the high of this day was 727. So it most certainly did hit 2R on the first day. So half of 17 shares, I would call that 9. So on both of these strategies, it would hit 9. And then I have to look at the previous day high or low or the 10 EMA. So for this, on this day, it opened at 709.48. No, excuse me, it opened at 718 and went down to 709.48. So it would have violated the low of this previous day. So the low is 711.96. I have to look where I would put my stop. Adjusting the stop. Plus or minus 1 penny. Okay, so if this low is 711.96, minus 1 penny would be 711.95. So on this strategy, I would have gotten stopped out at 711.95, and I would have sold the remaining 8 shares. Then this one says, when does it touch the previous day's EMA? So this is another thing I learned by back trading, is that on this day, the 10 EMA was at 699.50. On this day, the EMA is 699.73, but realize I would have set my sell order based on the previous day's EMA. So as you go through your back trading, you realize whether the strategy you have written is easy or difficult to execute, and then you can change your criteria to make it easier to execute. So basically, on this day, January 14th, I would have set a sell stop at 699.50 based on this 10 EMA. And then on the next day, January 15th, that would have crossed that. So my exit would have been at 699.50. So I come in here and I update 699.50. And then I would have sold the remaining 8 shares. And then I can look over here and see that if I had sold it the previous day, high or low, I would have gotten 2.5 hours on that trade. If I had sold at the 10 EMA, I would have gotten half an hour on that trade. And if I had done a combination, so sold half at 2 hours, sold 25% at the previous day's low and 25% at the 10 EMA, I would have gotten 1.5 hours on that trade. So guess what I do next? I rinse and repeat. Now I could have done this one, and I probably should have. But I have only 4 minutes left before I need to start doing research. So I'm just going to make a note that I need to go look at 15, February 4th, 2015 on CMG. And that is a gap and go. One thing I'm wondering is if the retest gaps or the gap and goes would work better based on different exit criteria. So I'm capturing that data and I can go back and run the analysis later. But that is how I back trade, and I use TradingView, and basically I just keep scrolling back and I see there's a nice consolidation pattern and there's a gap, so I'll come and check that one. This one, I'm not sure. I'll have to check to see if this one qualifies my criteria of a consolidation pattern. This trough right there may make it not qualify. This is not a consolidation pattern because this is just a steady run up and then a gap out of that. And basically I just scroll backwards until I find the criteria for my strategy and then I fill in the numbers. So that's how I back trade. It is extraordinarily valuable because A, you get to test your strategy. You also get to test if your strategy is executable. Basically, does your stop criteria make sense? Does your adjusting the stop criteria make sense? Because sometimes you type it out and it makes perfect sense, but once you actually go and do it via back trading, you find out, that's not very clear. I need to make it more clear. Like I discovered, instead of doing the 10 EMA, I have to do the previous day's 10 EMA. And I also had to better identify or better define and write out what a consolidation pattern qualifies as. And then lastly, you also train your eyes by back trading. So by going through and doing all this, you train your eyes as to what counts and what does not count, and so you can better execute your strategy. So thank you, Chris, for sending in the question. For more information on things like this, go to www.reallifetrading.com. And again, thank you guys for the questions. If you have questions or things you want me to answer or videos you want to make, please send me an email, brad@reallifetrading.com. Thank you, everyone.